All right, we're going to talk all about business acquisitions here because there's a number of people that have gotten into space. Now, this has been around for a very long time in private equity space. People have been buying private equity for decades. Typically, though, these deals are happening at a much higher level, 75, 100, $150 million. And if a normal investor, accredited or otherwise, wanted to invest one of these, you would have to be accredited and you'd have to have a financial advisor who has the inside track on these non-publicly traded companies. But there's a number of people who invest in equities in the stock market. If you look at the asset allocation of a millionaire, I don't have it exactly in my head, but it's probably about, it's like 40% stocks, bonds, 25% private equity, and 25% of real estate, and then there's a bunch of other stuff in there. So if you look at multimillionaire asset allocation, private equity is kind of a big deal. It's a fairly large percentage of someone's asset allocation. So what is that really, right? Fundamentally it's buying into an operating business. And what we're going to talk about here is not doing it at $100 million level yet, but it's really talking about smaller operating companies. Okay, and so that we're going to talk about that. And now, why business acquisitions? And for me, and just like I mentioned here, it's really like an asset allocation diversification play as well. Traditionally, we have been known as multifamily investors and operators. That's what we've historically done. It's the only thing we've done. And if you look at other syndicators, some have kind of ventured out into other asset classes, maybe some mobile home parks and things of that nature. But I would say probably recently, over the last 2 years, a number of my peers have really gotten into some alternative asset classes, including buying businesses of various different kinds. And it's just interesting when someone who's normally known to, buy self-storage. I had a friend of mine, build a multi-million-dollar self-storage portfolio, and 2 years ago he kind of stopped and he started pivoting into buying businesses, and he bought like an architectural firm. I'm like, dude, what are you doing? He's a smart guy. I respect him. So it was very odd to have someone like that kind of pivot away from something. And so every time someone smart does something that's a little odd, yeah, they could be crazy. It's possible, or dumb. It's possible also, but I don't think so. I start studying these things, and I've been studying this thing probably 2 years ago. And also the other thing I've noticed is that there are market cycles with an asset class. On the one hand, you don't want to be spread so thin where you're doing a bunch of stuff, you're never really good at anything, which is the argument for going deep in one asset class like multifamily. On the other hand, there are cycles, market cycles, and multifamily has been in an extremely long tear, arguably since probably 2010, lasting all the way to 2022. So it's a 12-year streak where things just started growing slower, a little faster, and it's just been thing. And you kind of forget that there's a cycle. And there are cycles, and so I have just concluded that from an operating perspective, also from from an investment perspective, to be a little more cognizant of market cycles. Not that you should trade in and out of a market cycle, simply to be aware of them. There's some things that have headwinds and some things that have tailwinds, and as a result, really, our company really has slowed from an acquisition perspective, and that's a lot of times because it's been harder to find deals as well. So let me ask you the first question: is, are we getting out of multifamily real estate? The answer is no, we are not. We are simply diversifying, and so I have always felt that Nighthawk Equity, which is our investment firm, really should provide different asset classes, different risk profiles. And we've traditionally been in real estate equity in the form of multifamily real estate. And that's super cool. Real estate equity is super, super awesome. There's also a thing called real estate debt, and that's become more popular because it normally returns a constant 10% per year. It's a little bit like money market accounts, slightly more risky, but it's in the first position, typically 50% loan on value on, say, flips and commercial things of that nature. So it's pretty conservative. 10% is not too shabby. And so there's real estate debt as well. And then there's private equity, okay? Now, besides from, of course, normal stocks and bonds, and there's private equity, okay? So I've always felt like I want to give our investors kind of different kind of asset classes to invest in so that we become known as the company that has high quality investment vehicles that fit someone's asset allocation and diversification as well, and private equity is part of that. So I've always felt that, and like I said, the last couple of years I've really become much more interested in this private equity space. Really started studying it and talking to a lot of people to the point where we want to now get into the space. And so That's kind of where we are right now. So we are not getting out of multifamily real estate. Now, I want to address some of the concerns that some people have listening to this, and the first one is, I mean, shouldn't you focus on kind of what you're doing right now, stay in your lane, and kind of fix what you have going on, And if you've fallen for a little while. You know that 2.5 years ago, the multifamily market took a bit of a dive because of the huge rise in interest rates that we've had to deal with, and that created an issues for a number of operators, and we're not immune to that. And it's been difficult, to be honest with you, to deal with this higher interest rate costs and cap rates and things of that nature. The other thing on top of that, not only that, but rents actually have been going down because of the free COVID money. A lot of apartment building developers started building stuff. And so starting last year, we had all these new shiny Class A apartments come out of the ground, and they need to fill them up. So what they did is they started reducing their rents and creating incentives to fill up those units. And those rents, in many cases, affected Class B, Class C housing just to fill those things up. And we have at least a couple of them that are directly affected with a neighboring Class A that dropped their Class A rents to Class B levels. And so the only thing we can do is drop our rents now below that point, and that really has put a lot of pressure on these properties. So there's been a few headwinds on that. And so let me address that first right now is we have the advantage. We've only done 2 deals in the last 24 months. The advantage of that is that we've really been essentially forced to focus on operations. And so our number one priority is to do the best that we can to operate this portfolio and to really right the ship and preserve investor capital. And so we have an entire team, right? We have a full team. We've pivoted away a year ago from a new property management company. We have a full-time asset manager. We actually have an assistant asset manager. We have an investor relations person. We have full-time construction manager. Two of my so the partnership is three, myself and two partners, Drew Niffen and Garrett Lynch, and two of those three partners are exclusively focused on the existing portfolio. And that leaves me to have at least one half eye open to some kind of growth. And I'm asking myself, well, how do we do that, right? How do we even begin to grow? How can we even plant a seed now that sometime in the future we have the ability to grow? And so we have a full team basically working full time around the clock on our portfolio. We've now brought our leasing in house as well. And we've made a conscious choice to slow our multifamily acquisitions so that we can actually do the things to really focus on our portfolio. But again, you have to have a little bit of eye on what can you do now. And I feel pretty confident multifamily is coming back. Rents in some areas like Dallas have already bottomed out and started increasing. We are expecting that to happen in the Atlanta area maybe in 1 or 2 quarters as the absorption completes. And so we do think that there is now a time where we can start becoming a little more aggressive on multifamily. Right now, we're a bit cautious. So the question really is, what can we do now to kind of plant seeds in the future that not only allows us to grow cautiously, but also gives our investors different kind of asset classes? So now you have kind of background of where I am right now, looking at these private equity and buying a business. Now, you might ask, well, what the hell does Michael know about a business? And like, for example, an HVAC or plumbing company or some other company like that. What do I know about that? And it's true that I may not know something about an HVAC business or roofing business or some sort of like that. But here's the thing: I know business. Okay, I've been running businesses since 2005. I've run a pizza business, obviously, as you may know, unsuccessfully. But I've run a pizza business. I've run a. Oh, all right, we got someone here that is not on mute. Let's see here. Let's see if we can turn everybody to mute here. Eric, if you're still on, I don't know, for some reason I'm not host. Yeah, if you're not on mute, that'd be great. I do not know why. Okay, that sounds better. Thanks so much. Okay, cool. All right. What I was saying. Yeah, so I ran a pizza business for about 10 years. I ran a flipping business for about 5 years, started a multifamily investing business, and then also have a coaching business, right? So these things really have nothing to do with each other. What I've realized is business actually has some commonalities in place, and there's really 3 things that a business must do. There's 3 main buckets. One is it's got to acquire and retain talent. That's number 1. Number 2, it's got to acquire and retain customers, right? So that includes sales, marketing, fulfillment, and then it's got to retain cash. So there's got to be strong financial management practices and things of that nature. And so all those things any business must do. And are there nuances in each business? Yes, there are nuances. And that leads me to the next point is whenever I have gotten into a new business or whenever I have talked to someone who got in a new business, I'm curious, well, you knew nothing about that. How did you do that? And it's a who, not how problem. So this is also what we teach here. If you want to go from, single family houses into multifamily, it's a who, not how problem. How are you going to get into this business if you've never done it before? Well, what's the best way to do that? The best way to do that is have advisors around you, to have a team around you who actually know these things. So in the particular case of buying a business, and I'm just going to keep going about HVAC business as an example. I'm not saying necessarily that's what we're going to buy, but when you're buying an HVAC business, you want to make sure that you're buying a solid company that's been around for a long time, that's got a strong leadership team in place, and that the owner has a strong number two and a leadership team in place. And you should be working with an advisor who understands mergers and acquisition, M&A. You should be working with an advisor who understands the particular vertical that you're buying. Okay, and then you have to have a strong team of professionals around you. The attorney is going to do the transactions, the CPA, the fractional CFA. So it's a CFO. So it's kind of a team approach. So with that being said, this is kind of the general background on breaking into a new business as well. Now, what's our playbook going to be? Well, let's start with a buy box first, and I'll tell you what our playbook is going to be. So our buy box, and I just started hinting at it already. It's not so much a vertical, though. There are things that we're narrowing down in particular verticals that we like. But in general, we are looking for business that have at least a 10-year track record, that have growing revenue and stable margins, that has a relatively stable management team in place, so that there's not 100% reliance on the owner. Now, in order to do that, you're going to have to buy a company probably with a minimum of $4 million in revenue, probably like $5 million, so $5 to $10 million in revenue, so that you can buy a company that is like that as well. So that's it from a kind of what the characteristics of that business need to be. It's got to be a business in a vertical that can't easily be replaced by AI, which is a bit of a head scratcher, right? Because there's a lot of stuff that can be replaced in AI. Something that's not cyclical and that's relatively recession resistant. And so right now, as we stand right now, that narrows the buy box right now specifically to the trades, HVAC, plumbing, things in roofing, that kind of stuff. Is kind of what we're looking at right now. And the playbook is going to be something like this. So what private equity typically does, they come in with a lot of money, they come in with a team and advisors, and they have to basically force appreciation as quickly as possible. It's almost like a value add deal that we do in multifamily, because we have the construction manager, we have the asset management team, and we're going to push on this asset so that in 2 years, we're going to renovate the exterior, the interior, so that we can drive up rents and push value. That's what kind of private equity does. I don't want to do that in this space, okay? It's too stressful for me. I really want to build something over the long haul, right? So I want to build something that'll hold for 10 years. And so my approach is going to be to find that right company that fits our buy box, like I just described, where there's a very orderly transition from the current owner to the number two person. And that's really what I'm insisting on is that number two person. And the less that the owner is doing right now, the better. And the interesting thing about it is there's so many baby boomers that are retiring right now. And I don't know the exact numbers, but they're in the bazillions, okay? And 75% of those baby boomers, they do not have a plan for succession. They don't feel like anyone in their company can run the company when they're gone. None of their family wants to do it. And then for some reason, they don't list it for sale. I've studied this. And why is that? Literally almost every single one of these buyers have put their blood, sweat, and tears in these businesses over the last 25 years. They're going to sell this thing for $5 or $10 million. Really did great for them and their family, but they have a lot of identity wrapped up in this business. So they don't want to sell to some knucklehead buyer who's going to destroy their legacy. So typically the private equity playbook is to go in there and cut costs, because it immediately jumps NOI in the valuation of the business, right? Is to cut costs as quickly as possible. And so a lot of these sellers really don't want that, because they really want to take care of their employees, and they don't want someone coming in there to fire everybody and replace everybody with a bunch of cheaper workers. And I've seen this happen. Even our local pest control company was bought, and I know someone in there, and it was bought by a much larger company. That's exactly what they did. And basically 90% of those people left. Really what they bought the customer base. And so a lot of these sellers don't want that. And so our approach is going to be the anti-private equity approach a little bit, which is just fine by me, where we want to come in there and have a little bit of a slower playbook. So my approach would be, once that company is found and that has that strong number two in place, that's ideally only already running the company, for the first 90 days, we're not going to do anything at all. We're just going to observe. We're going to spend quite a bit of time in this company as well, probably the first 90 days, probably weekly. So it better be local or I'm going to be playing a lot or someone's going to be playing a lot. It'll probably be me. Really get to learn that business and build rapport with that team. And then what's going to happen over time is we're going to apply the thing that we really bring to the table is sales and marketing, culture, and systems, and to some degree technology related to that here, right? So bringing that sales and marketing that I have built up over the years on the sales and marketing firm, specifically in the coaching business, which is so sales and marketing heavy, where we get into paid Facebook ads. We have a sales team, very sophisticated follow-up process. And I've observed that people have gotten into this, what I call from the online space in the offline space. They've done the same thing. And they really make a material difference because these offline companies have very, very little sales and marketing. It's wild to me that a $10 million, commercial, whatever, HVAC company has basically 100% word of mouth, and there's no sales and marketing at all. So bringing that sales and marketing in there, also formalizing culture. Everybody has a culture as well, but really formalizing that culture and then using it to address the first bucket I talked about, which is attracting and retaining talent, right? So this is all about recruiting funnel, development programs, making a big deal out of the culture. People want to work there and stay there, putting the right incentives in place. That's really, really important. And then on the systems and tech side, right? How can we intelligently apply technology to a business that's typically been offline? How can we use that to streamline everything from how leads come in to estimating and fulfillment and follow up and the scheduling, all that stuff. And some of these larger companies already have solved this. Companies that are $50 million in revenue have already done that, but a lot of these guys at the $5 to $10 million in revenue, they're kind of stuck at that place. So over time, we can bring a lot of this collective learning that we've brought here in place over the last 10 years to that business. And then from a Nighthawk equity perspective, we can actually leverage a team that we have built right now. We have the ability, we have an asset management team, we have financial oversight. Right, we can leverage that. We can bring this to our investors as an alternative to some of the real estate equity we've done. We have now someone that can take care of those investors. That's really cool. And so we can leverage that team. We're not starting from scratch as well. So that's really, really important. So that's kind of what our playbook is going to be. I want to talk next a little bit about how these deals might look, as it's quite a bit different in multifamily. So let me talk about that next, and then I'll talk more about the potential risks, as there are quite a few, and how we can mitigate that. And then, we'll see what else I got on my list here. So structure and returns. What's interesting about these business acquisitions? Let's talk about kind of the upside, and we'll talk about the downside. The upside of these businesses are very, very interesting. What is normal in these businesses, in any kind of private equity, especially in the lower market, is that you're buying businesses between 2 and, at the very high end, 8 times EBITDA, or let's say net income on profit. So typically, when you're buying somewhere around 5 to 10, you're going to be buying around 2 to maybe 5x. So let's just go with a higher end 5x. Okay, so what this means that if I'm buying a business with a $2 million EBITDA, that's after all expenses, right? $2 million, and I'm doing a 5x multiple, I'm buying that for $10 million. Now, just to put that in perspective, okay, that's like that's like a 26 cap. That's what I'm trying to say, right? If you do the math on that, the 26 cap that you're buying, which obviously we're buying a multifamily at a 6 cap, not a 26 cap. So meaning that if I'm buying at a 5x multiple, then that's the number of years it would take to get my money back. Okay, and that's pretty amazing. It would take a long, long time to do that on multifamily. So much so that if we were to syndicate a business acquisition, okay, the actual, and let's say you put a pref in there, the cash flow is so high in these businesses that not only there's an excess. So there's let's say 8% pref, and that cash flow that goes to the LPs actually covers the pref and is left over, and that leftover piece goes towards their equity. In other words, you get a return on equity, which is the pref, and then you get a return of equity. And so I've studied the structures of other people who have created funds around this. What's interesting is that because of that, now depending on how it goes, investors get their money back somewhere between 3 and 7 years. So let's say 5 years, right? You have a kind of a worst case, best case, and kind of what we think is going to happen case. And investors get their money back in 5 to 7 years without a liquidity event. And that's really, really interesting because now we can actually stay in the deal. I don't have to refinance. I don't have to sell. We can actually continue growing this, and we can take it a company, that's been doing $10 million right now to maybe $15 million in 5 years. That's pretty cool. But if we had a longer runway, okay, maybe another 5 years or so, we can actually possibly get to a $50 million revenue, especially if we start buying smaller companies and bolting them on into that mothership. It's called a platform company, because that's really also part of the growth plan, which I forgot to mention. We really want to build out a platform company, create the systems, the culture, ideally buy one that's already in place or 80% there. And so what happens is with these deals is not only is the cash flow very high, much higher than a multifamily, but also the returns are there, because as we increase the revenue, we obviously grow the NOI, which is what we know, and therefore the value of the company goes up, which is super cool. But the interesting difference with private equity is that as the EBITDA goes up, okay, the multiple also goes up. Okay, now parse that for a second. So if I'm buying something at a $2 million EBITDA and I'm buying it at 5x, if I grow that company to 5 million in EBITDA, it is possible / likely that I'm now actually selling it for an 8 or 10x. So it's almost like I'm getting into a multifamily building and I do something, and not only does my NOI grow so the value goes up, but I actually compress the cap rate. Okay, now that's interesting, okay, and also unusual. And so the idea here, what people are doing this from a strategy, this roll-up plan, is you basically invest in this platform company, get it going, and create some growth, and then bolt on these other smaller companies into it, so that when you get to 50 million, not 50 million, let's say you get to from 2 million, let's say to 15 million in EBITDA, doing whatever $60 million in revenue, now you're selling that company not for a 5x multiple, but for a 20x multiple to a private equity company. Now, why would they want to do that? Well, they're doing the same thing we're trying to do on a bigger level. They want a very mature company, right? They want a mature company that has proven growth and systems, and they want to continue what this company started and continue bolting on and continue maybe creating a national brand. Waste management, for example, that you may know, that's exactly that was their strategy. They didn't need to grow their customer base through organic growth and better sales and marketing. Their growth strategy was simply to buy companies and incorporate it into their systems and their culture, and that's how they grew. And so a private equity company, that's what they want to do. They want to take that $15 million EBITDA and turn it into a $50 million EBITDA, right? And then sell it to some kind of gigantic fund. I don't know what comes after that. So that's very interesting. Now, the downside of the private equity here is that you don't get these tax returns that we get in multifamily. And so this very much active income when you're earning from that. So you're getting a higher cash flow, but gosh darn it, you're also paying taxes with it. So in my mind, I think and this is, I think, why, billionaires, millionaires do an allocation like that, because you get a lot of tax benefits from real estate that you don't get in the other parts of their portfolio. So if you play your cards right, the multifamily real estate equity can now offset some of your other investments you have in your portfolio. So to me, there's still a play for doing both real estate equity, real estate debt, and private equity, like I've described. So that's kind of the structure and the returns, how that works. Now, here's the potential risk here, okay, and how we will mitigate some of this here. So the biggest risk for me is operational. I mean, yes, there is a market risk. There's always a market risk, right? Because the idea, though, you're buying a company that can't be disrupted by AI, can only benefit from AI. That's ideally not cyclical and somewhat recession-proof. For example, we're looking at HVAC companies and they have a high exposure of real estate new construction. I don't like that, because now you're pegged to the real estate development market, which, as we know, is cyclical and is not recession proof at all. So I don't like that. What I do like, though, is maintenance, and service calls, right? Because if you're in Texas or in Phoenix and your HVAC goes down in July, guess what? I don't care how much I'm going to pay you. I just want it done like right now. Right. So in that case, it's still relatively recession resistant. So market is going to be there. It's definitely a consideration as we buy the kind of verticals. But to me, the number one biggest risk really is the operation. Okay. And with that, specifically the operator, the GM, the president, the CEO, whoever's running this, it's 100%. It's got to be that is the number one thing. So what's going to be important to mitigate that risk is you got to buy, everybody, if you're going to do this, you got to buy right with a solid transition and pacing plan from the owner to seller. Okay. And that could mean that the seller is now agrees to be operational hands-on for a year and then is going to be in an advisory role for another year. And typically the way you do that is you make them essentially finance a portion of the sale, and they get what's called an earnout. So they only get that thing that they financed if they hit certain milestones. If they don't, they get paid less or nothing at all. Okay. If they drop the ball and they sail in the sunset and I got to clean up the mess, then they're not going to get the remaining thing, whatever they financed. So there's got to be an orderly transition plan in place. Ideally, what I'm looking for is I'm looking for that strong number two. Like, for example, we're looking at an HVAC company right now that is exactly in place. We have a retiring owner, 68 years old. He's only basically in the business 8 hours a week. And he has been grooming his number two for the last 7 years, right? Younger guy, super hungry, wants to blow it up, a little frustrated that he can't implement some of the technology and systems that he wants to do to make things a little better. So he's like, man, I'm actually kind of looking forward to this stuff. So in this particular case, there's a solid transition team in place. There's also a team behind it in place. They're doing $10 million in revenue, right? So there's someone that kind of does the sales, someone who does service and installs, that kind of stuff. So I like that. There's got to be a solid transition plan and a team in place. And then it's got to be a focus on attracting and retaining talent, right? So mitigate those risks is really a focus on those three fundamentals. So to me, acquiring and retaining talent, and I don't care what business one is buying, it's always going to be a challenge, right? If you're buying an HVAC business, you got to be able to find techs, hard to find. If you're buying a CPA firm, now you got to find high quality CPA people, right? If you're buying something in a medical space, you got to find those medical talent. So there's got to be a focus. As soon as that plan is in place, the focus has got to be on acquiring and retaining talent. That's number one. And then really focusing on those other two that I mentioned, the acquiring and retaining customers, focus on fulfillment. And by the way, when I'm buying a company, they better have an excellence under fulfillment. Like, I don't want to go in there and have a bunch of pissed off customers and complaints and trying to fix that. I do not want to do a turnaround. I don't want to do a value add deal. It's not like a multifamily deal. So in other words, the reason that this business is doing so well is because they really, really take care of their customers and they really, really take care of their team. Where they might fall down is in sales and marketing, right? And that's an area that I can probably help with as well. And then on the retaining cash, strong financial management. Now, this is going to be a little bit hit or miss. The companies we've looked at, some, especially the ones that have been trying to position themselves for sale, for example, have hired a fractional CFO to clean up their books so that when a buyer comes in, they're essentially clean. But people who have not done that, the books are kind of a mess, and it really complicates the buying process. But from my own experience, I've experienced what it's like to not have strong financial management, where I really don't know what cash is leaving, what cash is coming in, when. I don't know what my accounts payable. I don't know what my accounts receivable. I don't know what my delinquencies are, right? These are all things that are very, very important in strong financial management. So that's got to be addressed as well. So those are kind of some of the risks and how we mitigate them. So again, just to tie a bow around this stuff, this is something that we're going to start doing right now as a complement to our multifamily strategy. I'm also going to be shopping for a little bit of a real estate debt fund and maybe aligning ourselves with a very high quality operator that has been doing this for a long time, so that we can actually offer all three of these asset classes to our investors, right? So it's a little bit like an HVAC company, who expands into plumbing, electrical over time. We want to provide those different options because they have different risk profiles. They behave differently, different tax advantages, disadvantages, et cetera, to be able to provide those things to our investors here. And this is going to be done very cautiously because, again, we got to make sure that we have our core business taken care of. Also, I do not want to rush into this thing. I have an M&A advisor. I have a team around me that's helping me get into this stuff. I have the Nighthawk team behind me as well. For due diligence and financial oversight. But again, as excited as I may sound around this stuff, I've also been around the block with operating businesses where I know that this is not going to be an easy thing to do. I've talked to many people where they have told me this is a very fulfilling thing, but also challenging. I'm up for the challenge, but I want to do it cautiously as well. So just want to give everyone here kind of an overview of where we are and kind of where we're headed.